Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. We're here every Sunday morning, and as always, make sure you do tune into our live radio show. In addition, go to ReznyWealth.com for times and availability. I've been managing money over 30 years. I've been doing my TV and radio shows for decades. And one thing that I really enjoy is educating you, the investor, making sure that you can make better decisions around your portfolio, your retirement, and your financial security. This show is all about you. So make sure you send your questions to Brian Rezny at ReznyWealth.com. I'll get those questions answered on today's program. One thing I want to talk about is we're firmly into 2024, and generally speaking, the overall markets are doing quite well. Some parts of the bond market, short-term duration and floating rate type securities, which we talked about earlier this year, are the place to be, and we're seeing more emphasis put on intermediate to longer dated bonds as we get further into 2024, because again, we firmly feel the Fed's going to start reducing rates somewhat, not a lot, as probably the midpoint of 2024. That's going to bode well for the bond market. Remember, bonds go up when rates go down. When rates do come down, that could bode well for more future growth of the U.S. stock market. One thing that is vitally important for every investor to remember: know what works and do what works. I want to talk about that on today's program. When it comes to investing, and again, managing money over 30 years, we have a lot of clients that we've managed money for over 3 decades. I always look at how successful people invest and what causes a lot of people not to have success or have mediocre or poor returns with their portfolio. And it really is 2 principles: know what works, but also doing what works. Investment strategy is number 1. If you're an investor and you're doing what's called stock asset allocation, spreading your money out all over, which is kind of what Wall Street firms and the banks and insurance companies do, they put it in a pie chart and they kind of spread it all over. I'll talk more about that later. That to us is not really a strategy. It's kind of like owning everything in the pantry and putting it all in a pot and making a dish out of it. It's not going to taste that great. Your investment strategy needs to be succinct, it needs to be well researched, and it needs to be followed. Again, know what works and do what works. When you do develop an investment strategy like Rezny Wealth Management, we follow it to the T. That means daily research on not only the economy of the U.S. but around the world, but also the investments that we own. While we don't make a lot of changes to our portfolio daily at Rezny Wealth Management, we make changes when necessary with the portfolio. This is vitally important. If you have your strategy and you do your daily research, which is part of your strategy, you need to make adjustments to the portfolio when necessary, when there's better opportunities for the money you have. That might mean you buy 4 or 5 stocks, and you might own some of those for 4, 5, 6, 10, 15 years. But maybe one of those stocks falls out of favor in a year or 2, and there's better places for that money. Again, investment strategy, daily research, know what works, and make sure you follow through with what works. One thing that comes up often in our strategy is something called relative strength, and why does it work? Relative strength investing, in our opinion, is probably one of the best strategies overall to deploy when you're building a portfolio. What is relative strength? There's 2 parts of it. There's earnings relative strength, and there's price performance relative strength. Earnings performance relative strength, what that basically means is companies that are earning more money today and are projected to make more earnings tomorrow and in the foreseeable future have earnings relative strength. Earnings are a good predictor of where a stock price is going to go, or that particular equity market like the U.S. If companies have strong earnings and they're growing and looking for the future to grow, there's a good likelihood those stocks or those sectors will outperform weaker sectors on earnings growth or earnings negativity. So again, earnings performance makes a big difference in stock performance. Price performance is another metric. What's very interesting is we will often look at all the sectors of the S&P 500 as an example in our strategy. We want to own a handful of those sectors that are most strong based on price performance or price strength. That is vitally important for you, the investor. I think investors need to realize in today's times that if you look at the relative strength of a sector or an investment on price performance, those will often continue for some period of time until at which point earnings really supersede that price performance. What I mean by that is if earnings start to slow down, price performance often will follow shortly after. Investors, one of the things that you need to make sure as an investor is secure your retirement income. How do you do that? It's pretty simple. You need to grow your portfolio, growth of the actual portfolio, and you need to grow the dividend stream within that portfolio. We call that total return investing. I think investors who looking at growing their portfolio in retirement and living on some of that growth in addition to a growing dividend or income stream are going to be investors that are best positioned for future inflation and really solidifying retirement security. George in Florida, I've heard you talk a lot about total stock value or total return. How does one figure out this and the overall period of which time? George, that's a great question. What you're asking, I think, to put it more in a summary form is, what is total return investing? So total return investing is fairly simple. It's the growth of your assets. So let's say you buy a stock as an example, and that stock grows 8% in a given year and it has a 1% dividend. If it grows 8%, you have a 1% dividend, it's a total return of 9% for the year. On the other hand, let's say you go buy a stock that pays a 7% dividend, okay? And a lot of investors will gravitate to those kind of high dividend stocks, which is not a great strategy, by the way. On a total return basis, that stock that's paying a 7% dividend is dropping every year by 6% in value over the last decade. So what's your total return? Well, if you're making 7 on the dividend, but you're losing 6 on the stock price, your total return is only 1%. Take a look at a stock as an example, AT&T. It had a really good dividend for a long period of time, but the stock price kept going down, 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 down. So what is your total return on an AT&T stock over the last decade? It's miserable. Again, but people were fixated on that high dividend stream because they thought they had it figured out. High dividend paying stocks that are over usually 3% start to become more suspect. They should be suspect in your portfolio. I'm not saying they should not be bought, but it should put up an alarm bell when you start to see stocks that are paying over 3%. Can they sustain that? Are they borrowing money to pay that? Are they paying too much earnings out? Can the company no longer grow? Like an AT&T as an example, where the actual share price is actually going down. Dale in Florida, what are your thoughts on MPW, Medical Properties Trust? Dale, one of the things I want to stress is this is a publicly traded REIT. And one thing about the real estate market right now, there's a lot of turmoil going on. I'm not a big fan of traded REITs right now, and I'll tell you why. Interest rates are high. Until interest rates ultimately come down, and depending where these properties are located geographically around the U.S., some areas are doing pretty good. A lot of areas are doing pretty poor. So one of the things you want to understand before you get involved, whether it's MPW or any publicly traded REIT, we want interest rates to be down a little bit. You want to only buy traded REITs in areas geographically that they own real estate that are really growing economies and growing population. That's going to be your best opportunity. And again, when you're looking at, generally speaking, REITs, publicly traded real estate investment trusts, you want to avoid particular parts of the market that may be more office building related or shopping center related, as some of those areas are starting to slow down significantly within the U.S. Mike in Naples, what strategy would you use to invest excess cash in the current market? You know what? This is what I would do, Mike. If you're holding excess cash, I would try and get that money invested over the next, say, 3 to 6 months. No more than 6 months. And the reason I say that is, at some point this year, we're going to get a correction. I don't know if the correction is going to be next week or 9 months from now. But at some point, we're going to get a correction. We get one every single year of 10 to 12% in the U.S. equity markets. Sometimes it's a little more, sometimes it's a little bit less. But we could have the market go 5% more before it has a correction. So really what you want to do with that excess cash, the economy generally speaking looks good. I would get that money to put to work in the next 30 days. Maybe invest, a quarter of it in a week, another half was left in another week, and then maybe the last part in the next 3 weeks. But get the money invested, because time is on your side. You may buy at the top today, and you might have a short-term correction, but if I look at the next 3 to 5 years, you'll probably be a wealthier person investing properly today than waiting any longer. I'm going to take a quick break. Go to ReznyWealth.com. As always, if you're not happy with the way your money's being managed, whether you're self-managing, whether you're getting conflicted advice from a Wall Street firm, a broker, maybe one of these banks, call my firm during the week. We do manage larger portfolios at Rezny Wealth Management of $1 million and greater. And if you'd like to discuss our money management services, call us during the week or visit our website, ReznyWealth.com, and click on that consultation tab. Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report radio and TV show. I've just released a groundbreaking report, the 3 biggest risks you must avoid now. I've covered the major risks that create financial ruins for many retirees. If you're at all questioning the advice you're receiving, this is a must-read report. Go to ReznyWealth.com for your free copy. Educate yourself, protect your retirement and portfolio. I hope you're enjoying today's program, and as always, send your questions to Brian Rezny at ReznyWealth.com. We'll answer those questions on today's program, and as always, go to ReznyWealth.com. Make sure you click on our special reports tab, download our groundbreaking report, 3 biggest risks you must avoid for 2024. It's a must-read for any investor who's retired, pre-retiree, who is concerned about maybe the way your money is being managed, concerned about the national debt, concerned about the economy. If you want to learn and educate yourself properly, go to ReznyWealth.com for free. 3 biggest risks you must avoid for 2024, only available on our website. One thing I want to talk a little bit about is, when do you sell an investment that maybe is going south? Earlier in the show, I talked about an investment strategy. Part of that investment strategy is a sell strategy. Risk management. You have a bad investment. So think about this. If you go and buy a car, you go to buy a car because you need a new car. There's going to be a point in time where that car starts to get worn out, and there's better opportunities for better cars down the road, whether it's better gas mileage, it's less maintenance costs, things of that nature. Your investments are really no different than that. If you have a proper investment strategy and you properly research the investments before you put those in your portfolio, when the exact opposite starts to happen, the reasons you put them in start to go backwards, that's a good time you want to start selling. Don't wait 3 or 4 years when a stock you bought drops 80, 90%. If the earnings momentum or relative strength of the earnings of a company, the sales start to decline, the forward guidance becomes flat, those are often times you want to start looking at selling a particular investment. Maybe it's an individual stock. I don't want to pick on AT&T too much on this show, but that's a great example of a company decades ago that really used to be the leader in its industry, and all of a sudden the competition came aboard and really ate up AT&T's lunch. So like any investment, you may buy it and think you're going to hold it for the next 5 to 10 years, and you might. But then again, what happens if it is AT&T and all of a sudden all the competition comes around and it's time to sell before your investment goes down 70, 80% in value over a decade like AT&T? You own too much is another time you want to trim a position. Think about this. You bought a particular stock. Maybe it's NVIDIA. We own that as a fair disclosure in parts of our portfolio. It's gone up immensely in the last 3 or 4 years. So maybe originally you started with a 2% position, and that's kind of your benchmark in your portfolio strategy. But now it got to 4 or 5%. You should have a reason that you're going to trim that position over time. Don't let one position, no matter how good it is, overwhelm the portfolio. Because if you do that, ultimately you're taking a lot more risk. While a stock might be really good, there's going to be a day, again like an AT&T, where it's not so great. And if it's too much of your portfolio, if you're not properly diversified and you don't know when to sell, it's going to have horrific consequences to the performance of your portfolio and your financial security. The other big thing is time to raise cash. I often hear from a lot of my TV and radio show listeners on questions, Brian, is there ever times that you raise cash at Rezny Wealth Management? There are times we actually do raise cash. But we don't raise cash for emotional decision-making reasons. We use real reasons when we do raise cash in a portfolio. Think about this. On a routine basis, probably in your email box, you get all these different propaganda emails. And these emails are about buy gold now, world's coming to an end, they're coming to take your 401k plan or IRA, they're going to tax you, the U.S. government, they're going to take away the U.S. currency, all these kind of crazy emails that people receive today. This is propaganda. These are people are sending these emails out to get you all worked up so that you make emotional decisions, probably to buy a bad investment that they're trying to sell you. So again, if you're going to raise cash, you're doing it for reasons like the U.S. economy is peaking. It's starting to roll over. We're going to go into a recession. So you might raise some cash. But does that mean you're going to liquidate your overall portfolio? Absolutely not. If you're trying to short-term time the market, that's not going to work. And most investors are going to lose horrifically by doing that. So part of your strategy is realizing that you're going to have some ups and downs throughout the year. But if you buy quality investments that have earnings relative strength and price relative strength, you probably have a good opportunity to make above average returns in your portfolio and curtail major downward projections in the values of assets that you do own. Walter in Bonita Springs, Florida. Would your firm work with a portfolio of $900K? And what do you think about XBI? Great question. Our client portfolio minimum right now is $1 million. If you're close to that amount, Walter, we do make exceptions. And you're fairly close. I would suggest you call the office, discuss with one of my staff what you're looking for, and we'll see if we can make an exception. As for XBI, not an investment right now that I would own, and I'll tell you why. I think if I look at the biotech area, it's just very volatile. And I think if you're going to get into more of the healthcare side, I would look at like the XLV fair disclosure. We do own that in managed accounts at our firm. And I would look at that. I like the earnings growth potential of the healthcare sector in general. Relative strength-wise, it's been one of the better sectors this year so far. Again, relative strength, earnings strength, and then if I throw valuations in, valuations are very reasonable within the healthcare sector in general. So I like healthcare more than I would like the XBI. You might want to take a look at that. Again, do your own research. Nicholas in Florida. What do you see a rate hike in 24, and how will that affect the economy? So generally speaking, we see rates at some point this year probably coming down maybe 1 to 1.5%. I think we're going to get back to a normalization of rates. We're not going to see rates I don't think we saw 2 years ago where they're basically zero for practical purposes. How will that affect the economy? Generally speaking, the economy right now with these higher rates is actually doing quite well. So if rates come down a little bit, and the only reason rates are going to come down is if the economy slows a little bit and inflation gets to that 2% level and stays there for probably 2 to 3 months minimum, I think the Fed has a good chance of reducing some interest rates. That will have a positive impact on the economy and most likely have a positive impact on the overall stock market. And why is that? Because people have more money to go spend and buy more goods because less money, less interest is paying for debt. Jim in Florida, thinking about buying IUL insurance in an account for our kids. What are your thoughts? Jim, do not do it. Buying life insurance for kids is really a bad decision. It's not an investment. Your kids do not need insurance. Think about this. The only reason you really buy life insurance is a replacement of the income for the breadwinner. So Jim, let's say you're 40 years old. You have 3 kids and a wife. Your wife stays home. She raises the kids. You're going to work every day and you're the breadwinner. And if something happened to you, God forbid, what would your wife do? You need life insurance. Term insurance is the best way to go, like a 20 or 30-year term. It's cheap and it pays if you pass away, which is why you buy life insurance. Your kids are not breadwinners. Okay, so what you're going to do is you're going to buy expensive IUL life insurance that your kids don't need, that has high internal cost structure, again, that your kids don't need, And it's not a great way to invest. If you're going to, you open maybe an UPMA account for your children, you put some money in there, buy maybe an ETF of one of the indexes, and let the money roll over time and grow and prosper. Again, sectors that are growing earnings and in relative strength on performance is vitally important, but not insurance. Kids don't need it. You'd be wasting your money and really blowing it. I'm going to take a quick break. Go to ReznyWealth.com. Make sure you visit that website, download our groundbreaking report, the 3 biggest risks you must avoid for 2024. If you care about your retirement, if you care about your financial security, if you're worried about the advice you're getting, because it's kind of been lackluster or mediocre at best, this is a must-read report. It's free, and it's only available at ReznyWealth.com. Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report radio and TV show. I've just released a groundbreaking report, the 3 biggest risks you must avoid now. I've covered the major risks that create financial ruins for many retirees. If you're at all questioning the advice you're receiving, this is a must-read report. Go to ReznyWealth.com for your free copy. Educate yourself, protect your retirement and portfolio. I hope you're joining today's program. And again, send those questions to Brian Rezny at ReznyWealth.com. You know, we talked a lot about not only the economy so far this show, we're taking a lot of questions, but one of the things that I want to bring up, and again, often investors like you will have really mediocre returns. And you're kind of wondering, you hear about the stock market did this last year, and you only made this. You're hearing the stock market did this over the last 5 years, and again, your account kind of did this. You made some money, but you're not really making the money you should, given the risk that you're taking. So let's talk about real diversification versus the failed pie asset allocation. So how do you make money as an investor? You properly diversify in assets that have earnings, growth, and price appreciation momentum, or relative strength. You don't over-diversify a portfolio, you properly diversify. What does not work is called the failed pie asset allocation. And a lot of you have this right now. If you go look at your brokerage account at the big bank or institution, it's that round circle. And you'll see it cut up in 92 little slices of pie. Asset allocation, which is really pushed by the banks and brokerage houses for decades, in our opinion, doesn't work. Because you're owning a lot of everything instead of owning the things that actually are working right now or that are projected to work the next 3 to 5 years. As an investor, invest in what's working. How do investments work proper and go up in value? Earnings. Sectors that have earnings growth have the best opportunity to go up in value. You marry that with relative strength on that sector or that investment, and you bring those two together in a strategy. I think too many investors today, unfortunately, look at their account and the returns went up, okay? But they went up half what the market did. But when the market goes down, your account still goes down. So your returns are lousy. Not a good way to go. You made money, but you didn't make enough money given the risk. So think about this. If you took this level risk, you should make those level returns. If you're making lesser returns given the risk, that's not a good proposition. That tells me you're probably doing what's called asset allocation, more of the set it and forget it mentality, and in our opinion, it just does not work. Now, what's really interesting is when I look at a lot of these asset allocation pies, the last 2 or 3 years, the returns have been so subpar, it's really kind of sickening for you, the investor. So think about going 3 years and not making any money on your portfolio, and even still maybe being down on returns. And why was that? Well, it's interesting. Wall Street likes to push asset allocation, and part of that asset allocation is called often the 60-40 portfolio. Well, you're retired, so you should have 60% of your money in equities and 40% in bonds, because bonds are going to buffer your portfolio from risk. But what happened? In 22, bonds didn't do very well. In fact, they lost a ton of money. In 23, they didn't do very well and they lost a ton of money. So if you were in your general bond allocation in a 60-40 portfolio, not only did your equities not do well those last 2 years, but your bonds also lost a lot of money, maybe as much as the equity portion of your portfolio. That is not a great way to go. So make sure you don't fall for that Wall Street sales pitch. Well, you made some money, or we're trying to control risk, But asset allocation, I'm sorry, it just doesn't work. Rob in Cape Coral, Florida. What do you think about AT&T? Well, I talked about AT&T a few times in this show. If I owned AT&T, I would sell it immediately and move on to greener pastures. AT&T, while it used to be a great company and it used to be a great investment, those times have passed over 20 years ago. I would sell AT&T and I would do better research and position that money in areas where they have actual earnings growth in order to prosper your portfolio. Larry in Bonita Springs, Florida. I was sold 2 annuities 5 years ago. Both have no returns in that time, even though I was told I would receive stock market-like returns with no downside. Help. Larry, what I would say to you is this. Half of the people that call my office every week, half of the potential new clients, call and are disgruntled because they were sold annuities just like you. Half of the people that hire my firm have been sold 1 to 4 annuities, and I am yet in over 30 years to have somebody happy that they were sold these annuities. Blatant lies, disregard for the facts, hype, and really emotional selling tactics sell annuities. What I would say to you is this. If you bought these things 5 years ago and you were supposed to make stock market returns and you've made no money, that should answer your question. It's probably time to unload those annuities, find yourself a fee-only fiduciary money management style firm like a Rezny Wealth Management that can help get your portfolio back on track. Annuities, generally speaking, are garbage, and they're sold under emotional sales tactics to get you kind of geared up and really buying something that you should have never bought in the first place. If you want to learn more why annuities are dangerous to your wealth and retirement, go to ReznyWealth.com, click on the Special Reports tab, download for free Why Annuities Are Dangerous to Your Wealth and Retirement. It's a must read. Terry in Naples, Florida. I own 3 REITs. All are down in value and I can't get out. Do you have any ideas? Unfortunately, you probably bought non-traded REITs. Non-traded REITs, you can't get out of. That's the problem. So what I try to explain to every investor is when you own a non-traded REIT, you're stuck. You're stuck until they decide to sell, and that could be forever. So first thing is, don't get sold a non-traded REIT. You can actually buy traded REITs that you can go in and out of anytime you choose and get proper research, and they're liquid. So unfortunately, brokerage firms and banks like to sell high commission products, and those would be non-traded REITs. Folks, I'm just about out of time. As always, go to ReznyWealth.com. Honesty, integrity, compassion, and competence. That's the difference we provide with our real money management. If you're unhappy with mediocre returns, bad customer service, call my firm during the week. We manage larger portfolios of $1 million and greater. Go to ReznyWealth.com and click on the consultation tab. We'd love to help you get your portfolio on track and provide you the real money management and help you secure your future and your family legacy. Until next week, go to ReznyWealth.com.